Hi everyone, I'm Angela, one of your AAA module leaders. This video will give you a quick overview of what's covered in Unit 9. We'll now take a look at some of the final steps in completing the audit. At this stage, your audit program might look something like this. You've completed your pre-engagement and planning and risk assessment tasks, and you might have some existing substantive audit work or documentation that is being wrapped up. As you prepare to start finalizing the audit before issuing the auditor's report, these are some of the procedures that will be performed. Let's go through each one. When we talk about performing subsequent event procedures, we are referring to the period after the end of the financial period. Directors of an entity are responsible for ensuring the financial statements comply with IAS 10, and ISA 560 outlines the responsibilities of the auditor in respect of subsequent events in the audit. Let's take a closer look. Time period 1. During this time, which is before the date of the auditor's report and financial statements are authorized for issue, the auditor must perform procedures designed to obtain sufficient appropriate audit evidence that all material adjusting events have been adjusted and material non-adjusting events are disclosed. Time period 2. By now, the auditor's report has been issued and financial statements have been authorized for issue. Here, the auditor has no obligation to perform further audit procedures, and it is now management's responsibility to identify any subsequent events and inform the auditor. Time period 3. Here, neither the auditor nor management have any further responsibility to identify subsequent events. In practice, the auditor's report is typically signed and dated on the same day the financial statements are authorized and issued by the entity's directors. Evaluating audit evidence. When finalizing the audit, the auditor needs to consider whether sufficient appropriate audit evidence on the financial statements have been obtained. As this requires a high level of professional judgment, the audit partner usually makes this call. Sufficiency is about the quantity of the evidence. So, do we have all the evidence and all the samples? Think of it like if you were doing a puzzle. Do we have all the pieces to complete it? When auditing the existence of accounts receivable, have we received all the receivable confirmations? Appropriateness is about the relevance and reliability of evidence. So, is the evidence what we actually need? And is it the right final piece of the puzzle? When we talk about reliability, think of it like if we're auditing the existence of inventory, are we relying solely on verbal confirmation from management, or have we attended a stock take ourselves? Final analytical procedures. You may remember that we talked about performing analytical procedures during the risk assessment stages, which we called planning analytical procedures. The purpose of final analytical procedures is to corroborate conclusions formed during the audit. In practice, this is often done at the financial statement level, and a common reference point for comparison is the prior year audited financial statements. Generally, this may involve comparing the recorded amounts to develop expectations and/or calculating ratios and assessing whether they are in line with expectations. Let's consider an example. You are aware from your audit procedures that inventory purchases have become more expensive in the current year, and revenue has remained flat due to increased competition. As a result, you expected that there would be minimal movement in revenue and an increase in cost of sales and a decrease in gross margin. However, upon receiving the client's financial statements, you realize when you perform your analytical review that whilst revenue is in line with your expectation, cost of sales and gross margin movement is not. In this case, you would need to investigate and discuss this with management as it no longer corroborates the conclusions formed during the audit. Evaluating misstatements. Per ISA 450, a misstatement is a difference between the reported amount, classification, presentation, or disclosure of a reported financial statement item and the amount, classification, presentation, or disclosure that is required for the item to be in accordance with applicable financial reporting framework. So misstatements can arise from error or fraud. Just pointing out here that omissions can also be misstatement. For example, a non-disclosure of a material item is also a material misstatement. Let's look at some types of misstatements. Factual. Those where there is no doubt that they are actually wrong. For example, an under-accrual of a liability when compared to the actual invoice that is received after period end. Judgmental. Those that arise from subjective decisions made by management regarding accounting estimates that the auditor considers unreasonable. For example, inappropriate discount rates used in a long service leave provision. Projected. An auditor's best estimate of a misstatement projected from differences in audit sampling. For example, a $50 error in an accounts receivable sample out of a total sample tested of 1,000 across a $200,000 population would be extrapolated as a $10,000 error. Evaluating misstatements. When you identify a misstatement, you will need to track these in a summary of misstatements. More on this a bit later. For these misstatements, you will need to determine the impact on your audit. For example, does the audit strategy and audit plan need to be revised? You will also need to communicate misstatements to management and ask management to correct them. If management agrees to correct them, ensure that these flow through to the financial statements. If management refuses to correct them, you need to evaluate whether the uncorrected misstatements are material by both size and nature. The results of this assessment will impact the form of the auditor's report. Remember, there is no need to aggregate nor communicate clearly trivial misstatements. Let's look at an example of a summary of misstatements. For the purposes of this example, we are focusing on the size of the misstatements. Let's say the overall materiality here is 30,000. There are two misstatements identified here that are not clearly trivial. The first one is in relation to revenue over recognition of 35,000, and the second one is a 12,000 under-accrual of a liability. Let's apply what we've learnt. So if we are told that both of these are unadjusted by management, is there a material misstatement? For adjustment 1, this one is material even just by itself, as it exceeds overall materiality. For adjustment 2, this one is not material by itself. However, remember that we also need to consider them both in aggregate. The total impact to the P&L is 47,000 and 35,000 for total assets, which are above overall materiality. So in aggregate, these misstatements are material. So if management does not correct both of these, there is a material misstatement. Reviewing financial statements is one of the important steps of the audit process, as the auditor ultimately forms an opinion on the financial statements. Using a quick example of a statement of financial position extract, an auditor will generally perform the following. Ensure that audited balances are the ones reflected in the financial statements and are categorized correctly. They will also check that there is consistent presentation throughout. For example, the receivables balance in the statement of financial position is consistent with the note disclosure. They will also ensure that there is mathematical accuracy. For example, ensure that everything is adding down, there are no rounding errors. They will also ensure that comparative information agrees with prior year audited financial statements, and evaluate whether accounting policies reflected in comparative information is consistent with the current period. Where there have been changes, the auditor needs to ensure that these are properly accounted for. In Australia and New Zealand, within the financial statements, prior period financial information is included as an integral part of the current period financial statements, and is intended to be read only in relation to the current period. And finally, and overall, to check the financial statements as a whole give a true and fair view of the entity's financial position and performance, and comply with relevant accounting standards and regulations. When an entity publishes additional information in documents such as annual reports that contains the audited financial statements, this places additional responsibilities on the auditor. This is known as other information, which is defined as financial or non-financial information other than the audited financial statements that is included in the entity's annual reports. Let's look at some examples of annual reports. Here's the contents page of Telstra's annual report, an Australian listed, and Fisher & Paykel Healthcare Corporation's annual report, a New Zealand listed. These sections are the audited financial statements, the section that an auditor's opinion covers and what an auditor provides assurance on. On the other hand, these sections are what we call other information. An auditor's responsibility over this information is limited to identifying if there are material inconsistencies between the other information and the financial statements. If there are, the auditor will need to ask management to correct this, and if they refuse, evaluate the impact on the audit opinion, and finally communicate this with those charged with governance. No assurance is provided over this information, with the exception of the remuneration report for Australian listed entities, which is audited to ensure it complies with the Corporations Act. ISA 260 Revised is an overarching standard that addresses communication between auditors and those charged with governance. There are also some specific communication requirements detailed in some other auditing standards such as ISA 265 on deficiencies in internal control and ISA 450 on misstatements. Under ISA 260 Revised, the communication should be on a timely basis throughout the engagement and prior to signing the financial statements and auditor's report. In terms of the required communications, they are qualitative aspects of the entity's accounting practices, including accounting policies, estimates, and disclosures. For example, what is our view on management's accounting estimates, judgments, and assumptions? Significant difficulties encountered. Were there any significant delays or issues getting the supporting documents? Circumstances affecting the form and content of auditor's report. For example, are we qualifying the opinion, or are we adding any key audit matters? And finally, any other matters relevant to the oversight of the financial reporting process. And finally, ISA 230 recognizes that it may take some time after the date of the auditor's report to finalize and file all work papers. When finalizing audit documentation after the date of the auditor's report, keep in mind that this is an administrative process and it does not involve performing new audit procedures or drawing new conclusions. If you find yourself doing that, the audit report should not have been signed. The time limit for finalizing the audit file is dictated by the laws and regulations for each jurisdiction and may in practice differ by audit firm. Where no time frame is prescribed by applicable laws and regulations, the ISQC 1 guidance is that 60 days is a reasonable time frame. Similarly, the retention period is also governed by laws and regulations. Per ISQC 1 and in New Zealand, there is a minimum of a 5-year retention, whereas Australia has a 7-year retention period due to Corporations Act requirements. After you're done with all these steps, the finalize the audit section of your audit program should look something like this. If you have any further questions regarding Unit 9, please post them on the discussion board. Thank you for watching this video. Look out for other overview videos in the AAA module. Good luck in your studies.